This lecture will cover forward markets and contracts. So let's just first understand what is a forward contract, or as it's sometimes referred to, what is a forward contract position. Now, in very simple terms, a forward contract is a contract between two parties. Let's just call one party the long and the other party the short. So let's say we have party A, which is long, and party B, which is called the short party. Essentially, in a forward contract, party A, which is long, makes a commitment to buy something from party B, which is short, at a certain point in time for a certain price. So let's take a very simple forward position. Let's say that party A and party B get into a contract, and let's call it a 90-day contract, which means that if today is time 0, then at time 90, which is 90 days from from today, A will buy one stock of IFT for $100. So this is the contract, that on day 90, party A, which is long. Now, the long party is the party that is making a commitment to buy. So remember, long means the party is committing to buy, and party B, which is short, is making a commitment to sell. So in essentially a forward contract, we have the following. We need to say the contract is signed on time 0, but no money changes hands at time 0. And in this signed contract, we are saying that A is making a commitment to buy one share of IFT from party B, which is the short party. So the short party is making a commitment to sell. A very simple way to remember this is short, S for short, S for sell. So the short party is the one that is committing to sell, long party is the one that's committing to buy. The underlying asset here, which is sometimes referred to simply as the underlying, is one share of IFT, and the contract price, which is the price at which A will buy from B, is 100. So now all these terms over here will make sense. So I'm repeating this several times, but it will help you understand. So long position is the position that A has taken. This is a commitment that A will buy. Short position is the position that B has taken. This is a commitment that B will sell. Now, A and B are also referred to as counterparties. So from A's perspective, B is the counterparty, and from B's perspective, A is the counterparty. In the context of forward contracts, you will hear the term dealer and end user. So a dealer is an entity, typically a large financial institution, which essentially creates these contracts, or essentially acts as a dealer or the counterparty for end users. End users could be any corporation that wants to hedge its risk, or end user could also be another financial institution. So let's take a very simplistic scenario. So your end user might be a corporation that desperately wants to own a share of IFT after 90 days, and it does not want to worry about what the price will be. It doesn't want to take the risk of this price going too high. So in order to mitigate that risk, the end user, let's say, which is ABC Corp, so the end user gets into a contract with a forward contract dealer. So let's say that that's XYZ Bank. So ABC Corp gets into a contract with XYZ Bank. To essentially, ABC gets into a long position here, and the bank, which is acting as a dealer, gets into a short position. So in simple terms, dealers are entities that actually deal in forward contracts. In Pakistan, typically financial institutions such as Standard Chartered Bank, UBL, etc., are authorized dealers for derivatives oriented contracts. End users could be any corporation, as well as financial institutions could also act as end users in a forward contract. As mentioned earlier, when two counterparties get into a forward contract, no money changes hands at time 0. So essentially at time 0, the two parties simply sign a contract but don't exchange any money. In the context of forward contract, you should also understand what credit risk, default risk and counterparty risk mean. These terms actually are all synonymous. The idea being this: when parties, so coming back to my original example of A and B, so when A and B sign this contract, both parties are taking some credit risk. Why? Because let's look at A's perspective. What is the credit risk for A? The credit risk that A is taking, that on day 90 party B will not deliver. So that is the risk that A is taking, and that's called credit risk. Sometimes this is also called default risk, because it's the risk that party B will default. And this is also called counterparty risk, because from A's perspective, B is the counterparty. The counterparty risk then is simply the risk that the counterparty will not deliver per the commitment or contract that's been signed. Similarly, from B's perspective, there is again credit risk / default risk / counterparty risk, because from B's perspective, what's the risk? The risk is that B will be ready to deliver the asset, but A might not be ready to make the payment. So again, there is essentially the message here is that there is risk from each party's perspective, and the risk generally is called credit risk, but you will also see the terms default risk and counterparty risk. In the context of forward contracts, these three terms are essentially synonymous. Now let's talk about how forward contracts are settled. Broadly speaking, either a forward contract can be settled through delivery. So in my earlier example, this would mean that on day 90, party B actually delivers the shares of IFT, or I talked about simply one share. So one share of this stock to party A. So this is called delivery. If this forward contract is for some other commodity, for example, such as gold, then in a delivery based, where actually in the contract it will be specified whether it's delivery or cash settlement. So if we specify delivery in our contract, that means the short party has to explicitly deliver the asset or the underlying to the long. A cash settlement is where we simply settle in cash. So we look at the contract, we look at what the actual price is on this day 90 or on settlement day, and then whoever owes cash makes that payment. So I'll show you examples later of cash settlement, but here we basically make a net payment and the contract is settled. And finally, some contracts can be settled early. What exactly does this mean? So let's go back to our simple example. Initially, A and B signed this 90-day contract, which was supposed to be settled after 90 days. But let's say at day 45, party A wants to get out. So party A says that, okay, I no longer want this share. So what can happen? One thing that can happen is both A and B agree on a certain cash amount. So let's say that they both agree that A will pay $2 to party B, and both parties agree to end the contract. Now, how we come up with this amount is outside the scope of the level 1 course. You will see this in level 2. All you need to know is that if both parties agree, then the contract can be closed before settlement, and this obviously is one example of a early settlement. Another situation is where party A and B get into a offsetting contract. So in our example, A had taken a long position, B had taken a short position. So in an offsetting contract, what can happen now is on day 45, so on day 45, if A wants to get out, A and B can get into another contract where A now takes a short position and B gets into a long position. So here both parties have taken an opposite position, so essentially this contract is closed out. Why? Because according to the original day 0 contract, A was supposed to buy the asset, but on day 45 A is essentially selling the asset back to B. All transactions are supposed to be settled over here. Now there might be a certain cash exchange that takes place between A and B in order to get into this offsetting contract, but again, how that cash amount is determined is outside our current scope. All you really need to know is one way of early settlement is for both parties to get into a offsetting contract. And notice that when there is an offsetting contract, then there is no credit risk, because both parties have agreed on a certain amount to pay each other, and they have gotten out of the contract. No party owes anything to each other, and when no party owes anything to each other, there is no credit risk. And the final item on this slide is that you can also do an early settlement by getting into an offsetting contract with another party. The way this works is, so let's say that you are party A and you got into a long position with party B. So party B has the short position, and again on day 45 you want to get out of this deal. So if you want to get out of this deal, the first thing you do is you approach party B and see if you can either get into an offsetting contract or if you can pay some cash and get out. But let's say party B refuses. So then you need to get into an offsetting contract with another party. So what you do on day 45 then is you take a short position with another party, let's call that party C, which now has a long position. So essentially now you as party A have a contract with party B where you are long and B is short, and you also have a contract with party C where you as party A are short and party C is long. Now here there is credit risk. So even though you have an offsetting contract, but there is a risk that C will not deliver, there is a risk that B will not deliver. So while you have created an offsetting contract, there is still credit risk when you create an offsetting contract with another party. So now we are going to talk about several kinds of forward contracts, and in this reading we are primarily focused on forward contracts with financial assets. So we will talk about forward contracts with equity, with actually various kinds of equity, such as it could be a stock, a portfolio, equity index. We'll talk about forward contracts with bonds, with interest rates, and with currencies. Obviously a forward contract can be for anything. So if you get into a forward contract with another party to buy a car at a certain price on a certain date, that's also a forward contract. But in this reading we are primarily focused on forward contracts where the underlying is a financial asset. So when we talk about an equity forward contract, the underlying asset, or simply the underlying, could be a stock, it could be a portfolio of stocks, or it could even be a equity index. Let's see how this works, and I've already given an example before, but essentially building on that same example, let's say that you get into a forward contract to buy 1,000 shares of IFT common stock in 60 days for $10,000. That means effectively in your contract you are agreeing on a contract price of $10 per share. Now what is your position? Are you long or short? Remember, since you are getting into a position where you want to buy, your position is long. And here is what we are saying. So if we are right now at time 0, what we are saying is on day 60 we are going to buy 1000 shares at a price of $10 per share. So that's our contract price. We are essentially committing to pay $10,000, and in exchange the short party is committing to deliver 1000 shares. If this is a delivery, that is, the short will actually deliver these shares. Now this contract was signed on day 0. Now what is in it for you? So since you got into this contract, you are long. Notice that if the actual share price goes up to $12, then you benefit. Why? Because the share price here, let's say the actual price 60 days later, the actual price is $12. If the actual price is $12 and you have this contract that says that you can buy for 10, so you will get each share for $10, and then you could go into the market and sell it for 12. So on a per share basis you have made $2. And this illustrates the critical point that the long benefits when the price of the underlying goes up, and similarly the short benefits if the price goes down. And to see that, let's say if the actual price was $8 over here, then on day 60 if the price is 8, the short now has a contract that says that he can sell you each share for $10. If the actual market price is 8, he can go to the market, buy the stock for $8, and then just deliver you a share where you still have to pay $10 per share. So essentially if the actual price was $8, then the short makes $2 per share. So I'll just make it explicit that the short benefits when the price goes down. So this is important. Now again, to highlight the cash delivery versus to highlight the difference between cash settlement versus delivery, if this is a delivery, that means that the short has to deliver the underlying shares on this day. If this is a cash settlement, then we just figure out who owes whom how much. So if we had this situation, then on a per share basis the short will give the long $2, and obviously if the contract is for 1000 shares, then the short will give the long $2000 in cash, and the contract will be settled. Now let's talk about equity index forward contract. So let's say again that you get into a long position on a 90-day KSE 100 forward contract. So this is the most popular index in Pakistan. So let me just draw this out. Now this is a 90-day contract. Again, it is signed on day 0, and you have taken a long position with, let's say, a dealer. The dealer, for example, might be UBL, a large bank here in Pakistan. So you go to UBL and you sign a contract that says that basically in the signed document the contract price against the index is 10,000. Now this is the contract price. So what this is saying is that you need to, on simplistically put, the way you can understand this is, you can think of this as the index is just one big stock, and you can think of this as the stock price. So let's say that this is the index price that you have agreed to on this date. So the long essentially will buy one share of the index at 10,000 rupees. Now, and so you are the long, so you will buy one share of the index at 10,000 rupees. But rather than working in terms of actual shares, you also need to specify what's called a notional amount. So you specify on this contract, you specify a notional amount of rupees 10 million. So you have agreed on this notional principle. You have agreed that your forward price or the contract price is equal to 10,000. Now how we come up with this price is again outside the scope of the level 1 curriculum. We will see this in level 2. But what you do need to know is how much money actually changes hands then on day 90. Let's say that on day 90 the actual price of the index is 10,500. So essentially what has happened here is the index has gone up by 5%. So since the underlying, which is the index, has gone up, you, the long party, benefit. So you benefit because the index has gone up, and obviously the dealer in this case, which is UBL, loses. But the question is, by how much do you benefit? And the answer is simple. The benefit amount is equal to the notional principal, which is 10 million, multiplied by the percentage increase in the index, so or the percentage increase in index relative to the forward price. So the forward price was the contract price was 10,000. The actual index price on day 90 is 10,500. The increase is 5%. So your benefit is 10 million into 5%. Now typically index-based contracts are settled in cash. So since this is settled in cash, this is the amount that UBL, the dealer, will pay you. So UBL, remember, had the short position and you have the long position. And all these contracts are actually zero-sum game. Zero-sum game means that if one party loses, then the other party benefits, and vice versa. So here I also want to just illustrate one more point. You can also have a forward contract on a portfolio of stocks. So let's say that there is a portfolio that's currently worth 5 million, and this, let's say, has 20 stocks in it. Now you can also get into a long or short position on this portfolio. So say you are a portfolio manager and you want to hedge your risk. So what you can say is, you can take a short position where you say that you will sell this portfolio for $5.1 million in 90 days, and you might call this a cash settlement. So what have you done here? All you have said is to the counterparty. So let's say the counterparty is again some large financial institution. So here you are simply getting into a contract to sell this portfolio for 5.1 million after 90 days. And if the value of the portfolio now after 90 days is 5.1 million, then no cash will change hands. But what you are hedging your bets against, or what you are hedging, is the risk of the portfolio value going down. So let's say that the stock market crashes and the portfolio value comes down to 4.1 million. So you lose almost 20% on your portfolio. But since your risk is, so how did you hedge your risk here? The reason your risk is hedged is, even though the actual value of the portfolio is down, but you have already gotten into a contract with the counterparty, which is a dealer. You've gotten into a contract to sell for 5.1. So essentially the benefit to you is 1 million. Why? Because market price is 4.1 million, but you have the contract which says that you will sell for 5.1 million. So in this particular case, if this is a cash settlement, then the counterparty simply will give you 1 million on settlement date, which is 90 days from today. So effectively, I hope you see the fact that all sorts of equity contracts, whether they are with an index, a single stock, or a portfolio, essentially all work the same way. And you can simply, if you have trouble deciphering the three, just imagine that everything is like a stock. So if you just think of this index like a stock, or this whole portfolio like a stock, then the calculations essentially are similar for the index, for the stock and the portfolio. Now let's move on to bonds, and we will talk first about a forward contract on the simplest kind of bond, which is a zero coupon bond. This again works very similar to equity forward contracts. Let's say you get into a 100-day forward contract on a T-bill. The underlying is a $10 million worth 6-month T-bill. So if the T-bill was just issued, it will expire in 6 months. Notice that when we talk about forward contracts on T-bills or bonds of any sort, clearly the forward contract duration needs to be less than the maturity period of the bond. So we are covered here because the contract period is 100 days. This contract is saying that the long is committing to buy 10 million worth of a 6-month T-bill at a price of 9.9 million. So the notional, so in this contract, the notional principal is PKR 10 million. The forward price is equal to is 9.9 million. So essentially what that is saying is that the long party is going to buy $10 million or 10 million rupee face value T-bills for 9.9 million on this day. Now what happens actually on this day? The long is the one that will buy, and the long is going to pay this much. The short will sell this underlying, and the price agreed upon is 9.9 million. Now what happens if interest rates rise? If during this period, let's say that interest rates go up, if interest rates go up, then the price of the bond will go down. So if the price of the bond goes down, then the long loses and the short benefits. So again, this is typical when price goes down. So for any forward contract, here the underlying is the bond. If the price of the bond goes down, that's bad for the long and good for the short. On the other hand, if the interest rate goes down, then the price of the bond will go up, which is good for the, so for the long this is good and this is bad for the short. Later on we'll talk about forward contracts on interest rates which work the other way around. So I will talk about those later, but I just want to plant in your head that here if the underlying is a bond, then price going down is bad for the long, good for the short, and price going up is, price of the bond going up is good for the long, bad for the short. So here we simply talked about a zero coupon bond. What about coupon paying bonds? There the basic idea is the same. The coupon bonds are priced based on, say, yield to maturity, and the same principle holds. If you get into a contract to buy a coupon paying bond for a certain price, then if interest rates go down, then the long party benefits because the price of the underlying goes up. If you are dealing with bonds which have credit risk, so for example if you are dealing with say BBB rated corporate bonds, then your contract needs to specify what will happen in case the issuer defaults. We don't need to get into the details. All you need to know is that for risky bonds the contract needs to account for the possibility of default. If you found this clip interesting and informative, please visit my website www.arifirfanullah.com. Here you will find a tremendous amount of useful material. Right here in the 2011 CFA video lecture series, you will find the entire level 1 curriculum for free, and most of the material here is still relevant. So this is worth looking at. The 2012 video lecture series covers both level 1 and level 2. These lectures are available for a fee. And finally, down here, financial management at IBA. Here you will find my lectures at IBA for a course on financial management. Plus you'll find lots of useful spreadsheets that can help you with financial modeling. So again, please visit www.arifirfanullah.com. Thank you.